Hello and welcome everyone to another weekly market commentary from StashAway. Of course, with us again, our Chief Investment Officer, Freddy Lim. Hey, Freddy, how are you?
Hey, Philip. I'm actually doing the video as I'm on the road, and I'm in the office actually in the Philippines.
Very good. I can tell. That's good. That's good to see people at the office. So very good, Freddy. We did get very interesting questions today, so I want to get to them rather soon. But let's start with some global and local news, right, Freddy? Globally first, during the transition, Joe Biden is slowly taking shape of his cabinet, right? And one of the key pillars of interest to people who are in the financial space is obviously the Treasury Secretary position. Can you share a little bit more on what Joe Biden did there and what that impact is for investors?
Well, I was very pleased when he announced the pick as Janet Yellen, who was the chairman of the Federal Reserve before Jerome Powell, right? And she has seen during 2008 how Bernanke, her predecessor, has fought the recession, and she was also part of those who seen through all the operations the Fed has done through the years. So this is someone who is well ingrained with how the Federal Reserve works, and it's believed that she may be able to bring a better collaboration between the Treasury Department and the Federal Reserves, which sort of contrasts a lot with what Steve Mnuchin is doing recently, where he's allowing 5 emergency lending facilities expire, and they want the money back from the Fed by year's end, right? I think the numbers is something around $450 billion of seed capital they're going to pull back to the Treasury. And put into accounts is not easily accessible by the next Treasury chief. So lots of sabotaging going on, or lots of politics going on with the outgoing presidency. So I will stop here for now.
Yeah. No, but I think the market reacted quite friendly actually when it was announced, right? Had a couple good days right after the announcement. So for the market, they feel like probably they're dealing with someone they know, right? At least.
Well, the problem, however, is still like, at the end of the day, the Treasury chief is only the operator. The Congress, the 2 chambers of the Congress, dominated by the different parties, they have to come together and still find a way to approve a fiscal stimulus package. The operator can't really decide that. And so I feel like we still need to wait till February and see how that plays out for the government spending package.
Absolutely. Moving on, let's get a little bit more local. Today, there were some numbers coming out for Singapore factory output numbers, right? Would you like to get to the audience a little bit more details on that and what that means?
Well, the top line number is minus 0.9%, the decline versus the same time last year, so year-on-year basis. The big problem is not the actual number, but the expectation. The expectation for manufacturing output in Singapore prior to the release was plus 7.3 percentage point year-on-year. We went to minus 0.9, so it was a big surprise out there. So that obviously affected the Straits Times Index today a little. Not dramatic impact, but it's just, it's a cute joy. But the good news is you've seen good numbers in pharmaceuticals, you've seen good numbers in petrochemicals, biomedical, and I think precision engineering is the other one. These are the 4 components of the top line number that is actually registering plus 10, plus 15% year-on-year numbers. So the component, there's some winners in the industry and there's some but there are more losers on the whole. So
yeah, and for the other thing that's interesting to the audience is, because we've been talking about it a lot before, and it's always in the news in Singapore, is the allotment of banking licenses, digital ones, to the different conglomerates or people that applied for them, right? With China's scrutiny, is this affecting how the MAS looks at giving out these banking licenses, and what impacts does that have, Freddy?
Well, you can argue both ways, yes and no. The no camp, which is coming out of Singapore, is that, look, China regulates it differently in the past. Now they change it. That's got nothing to do with us. We haven't approved anyone yet. We have our own standards that are high in the first place. In the first place, we are focusing on not just good services, but also what's the right risk management framework around the digital banking players. So in my opinion, this is very true because China has let it go viral first, and there's been a lot of sponsorship. Like you put money in the bank account doing nothing, the people pay you 4, 5, 6 percentage point. Those rewards program is actually anti-competitive. It's a sort of a burning of cash to sponsor the acquisition of customer, right? It's very customary in fintech. But this kind of behavior now is going to be a little against the law in China. But also it sets a good tone for other countries to follow suit and regulate the same way. It's not just about a startup or a fintech company anymore. You're now a deposit-taking institution. You are systematically more important now, and there's a large numbers of people. What is the risk management framework when you're burning so much cash in rewards programs? Why are we treating you differently from a big bank? They couldn't do the same. So I think these are valid questions to ask, and Singapore doesn't have this problem, right? They have yet to approve anyone. Their standards are already there in the first place. So not an issue. Yeah.
No, absolutely. Let's move on then, Freddy, to questions from the audience, especially now that we are both on YouTube as well as having this session also on podcasts available for everyone. The first question is from Wood Liao. Hi, Philipp, Freddy. What do you think of current market versus next year 2021 results? Both Goldman Sachs as well as JP Morgan mentioned the S&P 500 index will climb up to 4,000. What's your opinion? Having said so, we should we continue the dollar cost average per month, correct? If the future will continue to go up after Biden, what about the situation happen if physical economy continues to get worse due to COVID cases, even though the vaccine is coming out?
I mean, 4,000 is not a far-fetched number. At some point, you will break it. Whoever gives you a number, at some point, you will break it because by nature, every year there are earnings at a certain rate of growth in companies, and then there's inflation. So you can easily always say that the stock market on average would average something in return. So for example, over the last 20 years, earnings yield average around 4.5%, and inflation is 2%. So you know that nominally, the stock market on average should give you 6.5%, and that was sort of the close to the long-term average. But that's a gimmick because the real number is in real terms. After adjusted for inflation, what is the real growth, right? So in this case, real earnings growth is really 4.5, or in the last 20 years, not 6.5. But we'll get there sometime. 4,000, 5,000, 10,000. Eventually, you'll get there. I don't want to predict the future, but I just want to say that it's better to dollar cost average because it reduces the volatility to your entire net worth. Because not all of it is exposed to the market today. You use that to build up your portfolio in a more stable manner. However, you don't have to do this if you think like, I'm a big boy, my risk tolerance is high. But a lot of people, most of us would actually need some consolation and comfort when it comes to the markets. So it really depends on your personal risk level, whether to dollar cost average or to just do a lump sum.
Yeah. And the next question was from Niraj. He says, hi team, I'm a recent investor with StashAway and looking to make this a primary long-term investment vehicle. So first of all, Niraj, thank you very much for becoming an investor. We're happy to have you on board. He says, I've been monitoring ARK ETFs in the US and I was wondering, will StashAway consider running an ETF themselves similar to ARK in the future, where management might be different from the current StashAway principle, but available for customers with a slightly higher risk appetite and those looking to get into a basket of growth stocks with momentum?
I mean, the ARK is a great fund that actively selects names to include and exclude in the innovation space. And if you're looking for exposure to genomics, industrial revolution names like Tesla or robotics and AI. Cathy Wood's fund is actually doing a very good job in selecting names. But what is the problem with the just being concentrated in ARK is that its volatility is fairly high. and some of the names that are being innovations and not exactly big names yet could actually be a liquidity issue. There's nothing wrong with that. Everything is about having an allocation, the right allocation towards something. So StashAway is a portfolio approach, it's not an ETF approach. So if you want more risk, we do have higher risk level. ARK is not in there because it's a lot of double counting already with the names that ARK owns versus say XLK, KWEB, and some of the names we have. So it's sort of like, because of our chosen risk level being massively lower than ARK, ARK is a lot more risky. It's a great fund, don't get me wrong, but its volatility, realized volatility, is just simply higher than any of our portfolio by a big margin. That is, we felt like it's not appropriate for a platform that promotes investing your savings and promotes safety. However, having said that, we are actually looking into something better than that, meaning combine the best in class from ARK, take what ARK would have done, do it ourselves, and combine with a stable StashAway portfolio that will make the whole lot way more resilient than before, and a whole lot more liquid, less concentrated than before. After all, if you want to invest in a game-changing, society-changing team, you need to be there for a long time to realize it. So we are actually working on something along those lines. You just got to stay tuned. I can't say more than that. The timeline remains unknown at the moment.
Yeah, no. Good teaser, Freddy, there. Good teaser there. And last question we have from Richard. It says, hey, Freddy, one question given the vaccine developments. Gold and silver have taken quite a beating and are down more than 15% from its highs of July. First, do you see the trend for gold to continue falling in price until the stimulus we hope comes? And second, after the stimulus comes and the vaccine is being distributed, will the price of gold continue to fall again? And will StashAway taper off gold? I have read that if the economy rebounds, the US dollar will likely fall, which may lead to the asset inflation you have been talking about before, resulting in the increase to gold prices. Just wanted to get your thoughts on this post-stimulus scenario.
Yeah, I mean, the user has posed the problem in details, and thanks a lot. It's impossible to predict, right? Because, I mean, if actually Biden managed to rally everybody and do a huge fiscal stimulus package, dollar goes down, paper money goes down, lots of supply of paper money around, gold goes up. But that's like a speculation, I guess. Or it can go another way up because the government fails to do so. The Fed suddenly step up further monetary stimulus and surprises everybody, and that also cheapens the US dollar and other paper money along with it, and gold will benefit too. But again, this is a speculative guess. It's event driven. It depends on an ability to predict exactly who's going to do what. So I prefer not to go there, but I prefer to view gold as part of the portfolio, where gold's role is very pivotal. Versus fundamental, actually gold still has valuation upside. It's not like expensive versus fundamentals, given what we are in now, pandemic and stimulus, unprecedented times. Gold also itself has a supply-demand situation where in the long term, the supply is actually relatively limited to demand. But more importantly, we are building it as a protective asset class that the portfolio needs to have in case there's an extreme event happens tomorrow to the markets, and in case paper money gets diluted so massively. Gold actually functions as a good hedge from both perspectives. We have a lot more than before in gold since December 2017. We bought it since when it was 1240, but we're still holding it because unprecedented times, unprecedented as allocations. So it's a tool for risk management. That's how I view it.
No, absolutely. Thanks, Freddy. For everyone else, thank you again for so many nice questions. Feel free to always post them, send them to our support team or email address so that we can pick them up next week again for you and get the conversation flowing. For everyone who wants to learn more, we have a couple upcoming webinars. In Singapore, we actually have a joint webinar, StashAway with Saxo, our broker together. It's called Investing in a Digital World with Peace of Mind. That's on the 3rd of December, so next Thursday, 7 to 8:30. Sign up, the link below in the show notes. And in Malaysia, also next week on the 2nd of December, we have an event called How to Invest the Right Way with ETFs from 6 to 7 p.m. Again, Both of those links to sign up for those are in the show notes below, as well as on our website. With that being said, Freddy, it was a pleasure speaking with you as always. And we are back with the audience next week. Until then, have a wonderful weekend coming up. Bye-bye. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.